Record. Well, welcome to our, discussion on Module 5. And if you recall, we are talking about chapters 12 and 13 here: risk, return, capital budgeting, weighted average cost of capital, and valuation. And if you recall, I also asked or mentioned there that preparation reading for this was chapter 11, where they talked about risk. And essentially, whenever you look, just recapping that for you, whenever you look at the riskiness of stocks, or a firm, risk return, the opportunity cost of capital, when you're investing money in a firm, you have to beat the opportunity cost of capital for that investment to be viable. You've seen that in net present value. It's the principle of value-based planning. Simply says that the marginal return should always be more than your marginal cost. Only then it will be a positive net present value project. So here, what is the opportunity cost of my capital? That was the issue, and that was what was discussed in chapter 11. They explained it to you. And they said that, when you, I'm just going through the background over here. So when, for example, if you look at the market, like S&P index, then what happens here is, if you look at the average returns that the market gave us over the past decades, several decades, when you average that out, how much was the premium that the market S&P index gave us? Premium means, what is the risk premium? Risk premium means how much over the risk-free rate, how much in excess of the risk-free rate, what you would get for zero risk treasury bills, T-bills. So if the market gave us, say, on an average 7, I don't know how much it was, 7 point some percent per year on an average, then this is the risk premium I'm talking. And if you add to that the risk-free rate, whatever you assume, say, let's say 7 point some percent was the risk premium of the S&P index over the past several decades, then and say the average treasury bill, T-bill per year was how much? Around 3% or something like that, or whatever it was. So if we add 3% and 7%, then 10% would be the opportunity cost of the capital, right? What I would get, the market would give you in excess of the risk-free rate plus the risk-free rate. So that would be the opportunity cost of your capital. You could just put your money there and get your returns. Why invest in a business, or why invest in something else? So that would be the opportunity cost of investing that money in your business or in your stock. So that was the concept of the opportunity cost of capital. And that is the rate that you would use to discount the cash flows from future cash flows from a project to get the present value of the project. The average risk project, which would be the risk of your, the opportunity cost of capital. That's what they started with. Now, for individual firms, when you're talking about the riskiness, it starts from the statistical concept. And the statistical concept is what? Mean, median, mode, and the variance and standard deviation. So the standard deviation of the returns of a stock would measure the riskiness, how much it fluctuates, right? So that would be the riskiness. That's how they started. You start with the variance, and the square root of the variance is standard deviation. So you do that, and that would be the risk. And then they showed in chapter 7 that, most of these companies, in all the businesses, in all the industries, there is an element of covariance. They tend to move together. Many of them tend to move together. Of course, there are some unique trends also, some are opposite in nature. So that is that's how you diversify your portfolio. But the commonality there, the risk was defined in two parts. One part was related to the unique business, the industry, the comp set, risk related to your business characteristics. That was the unique risk. And the second risk was how it varied with the market, macroeconomic variables. So that was the market risk. And over, by creating a portfolio of diverse assets, diverse stocks, they said that you can diversify away the unique risk. So you can average, you can just, you're focusing just on the market. In essence, the market index that we have, in theory, it should be the sum of all risky assets available, whatever it is, stocks, puts, calls, options, currencies, whatever you see, everything, risky assets, risky businesses, that is the market index. That is the market, the overall market definition, theoretical definition. But in practice, they take the market index in the index as the proxy for the market. So that's where we ended. And we ended with the concept of risk in chapter 7. We said that there is a difference between specific risk, which can be diversified away, and the market risk that cannot be diversified with the portfolio formation. That's where we ended chapter 7, chapter 11. Now we move one step forward, and that is, I'll start with chapter 12. And chapter 12 is on risk return and capital budgeting. And here we'll focus more on the market risk, because the unique risk is diversifiable anyway. So we'll focus more on the market risk, the beta, it is called the beta. And we'll focus on beta. We'll talk about risk and return, and we'll talk about capital asset pricing model, CAPM, and the opportunity cost of capital, how that can be used as that can help us get the weighted average cost of capital, which we'll learn in the next chapter. And that is used for the discount rate. You will discount your project, the future cash flows from a project from your company. You can discount it at the weighted average cost of capital. But for that, you need to know the cost of equity, the return expected from the equity, expected return from your equity, from your equity financing. And that is, you can get through CAPM, capital asset pricing model. And then we'll use that, combine that concept to calculate the weighted average cost of capital. So with that, we are ready to talk about measuring market risk. And first thing is about the market portfolio. The market risk is related to macroeconomic variables in the economy. And so first of all, we have to see how the market behaves in general. So, and in theory, the market portfolio is supposed to consist of all the risky assets. The person who got the Nobel Prize, Sharpe, for the capital asset pricing model, very nicely, it's a 2-page derivation, very nicely derived, how from the market you come straight to each security. So you take the entire universe of risky assets as the market portfolio. And from there, slowly, he zeroed down to each risky asset. And that gave us the security market line. And that's, and the beta. And that's how he got his Nobel Prize. So here, in theory, the market portfolio, when we talk of the market portfolio, we are talking about a portfolio consisting of all risky assets available in this universe. But in practice, we know that we just take the stock market index and use it as a proxy to represent the market. It's a diversified portfolio with the S&P 500, different stocks and those kinds of things. So you have NYSE index, weighted index, equally weighted index. We have S&P index. These are all different indices, okay? And they represent different markets, but this is what we take as proxy. And the covariance between a company's or your stock's return with the return of the market is the important thing. How it varies. First, the variance of your stock, how it varies with the stock market. So beta is actually the sensitivity or variability of your stock's return with the return of the market. So essentially what this is here, and if I can share a whiteboard with you. So if you can see the whiteboard, can you see the whiteboard? You can unmute yourself.
Yes, we can.
Thank you. Thank you, Brad. So when you take the covariance, which is the, covariance Ri, or I'll just write it down instead of drawing it. So text, right? So if I take covariance of Ri, I make capital R, I'll put Ri with Rm, with the market return, divided by variance of the market return, variance of Rm, this is actually beta. This is beta, covariance of your stock's return with the market, how it co-varies with the market, divided by the variance of the market's return. This is how it was derived, And when you look at this definition, how your stock's return, how your company's return varies with the market relative to the market's variance, market return variance. If you just replace the Ri, let us say you want to know the market's beta. What is the beta of the market? Then you replace Ri with Rm. So covariance of Rm with Rm is what? Variance of Rm. It is the same thing as variance of Rm. So you have variance of Rm over variance of Rm. The beta of the market is 1. This will be equal to 1. The two will cancel out. Do you understand? So this is beta. This is the concept of beta. Definition of beta is variance of your stock's return, the covariance of your stock's return with that of the market. So covariance of your stock's return, Ri, with Rm divided by the variance of Rm, and that is for the market. This is for market. For market. The market's beta is always 1. So now I'm going back to my old share, which is my PowerPoint. Can you see it?
Yes.
PowerPoint? You can just unmute and say it's fine.
Yeah, we can see it.
Thank you. So beta is the sensitivity or variability of a stock's return with that of the return on the market portfolio, and the beta for the market is 1. And if your beta is more than 1 for a stock, typically they consider it an aggressive stock. Why aggressive? Because if it is more than 1, simply means, say, 1.2. 1.2 divided by 1, that's what it is. So that means if the market changes 1%, then your stock will change more than 1%. It will change 1.2%. So it is considered an aggressive stock. And the opposite of this is a defensive stock, the defensive stock, which is where your beta is less than 1. Sorry, this should not be a minus, this should be less than 1. The beta of a defense stock was, I'm so sorry. I was just trying to change this. Can you see it again? My PowerPoint?
Yes.
Yeah, thank you.
Yes. Yep.
So the defense stock, it should be less than 1, not minus 1. There is an error over here. I was just trying to correct it, and that's where the problem happened. So I'm not going to leave it like this, but I'll change it later on. But it should be less than minus 1, less than 1. That is a defense stock. So utility industry stocks are defense stocks. Typically, their beta will be less than 1 point something. Again, in the utilities also, there are some utility companies that have more than 1. You have to be careful. Con Edison, for example, is less than 1. You will see that in your book when you read. But there are certain ones that are more than 1, and that depends upon the nature of that utility company. So this is some understanding of beta, a broad understanding of beta. We'll go into more specifics over here. So some examples over here from your book. I just took the seafood company. It has the following percentage return on its stocks relative to the listed changes in the percentage return on the market portfolio. The beta of this company can be derived from this information. So you just see, for example, it showed that first month, if the market return changed by 1%, then this company's return changed by plus 0.8%. Second month changed by 1%, it changed by 1.8%, plus 1.8%. Third month, again, plus 1% went minus 0.2%. So like that, if you take this further, you will see that when the market was up 1%, it changed 0.8%. And the market was down 1%, it changed minus 0.8%. See here, 6 versus 1. And then you have others. If you take the difference between this, I'll walk you through this. The average change of, between minus 0.8 to 0.8, if you take that average change, it will be 1.6%. The average change between these will be 1.6%. So when you're taking the average change of 1.6% and you divide it by the change in the market, which is 2%, which is, let's go back, minus 1 to plus 1. Okay, so this is minus 1 to plus 1 is 2%. So 2% change in the market, if you take that, then your beta, if the market changed by 2% and this company changed by 1.6%. So 1.6 divided by 2 is the beta, which is 0.8. In essence, what it is telling is, if you simplify this ratio, the 0.8 simply means that if the market changes on an average by 1%, market return changes by 1%, then this company's return changes by 0.8%. So this is a defense stock, obviously. It will change less. Got it? So that's, if you plot it, then this is what you get. Market return is on the x-axis. The company's returns are on the y-axis. The changes, return percent. And then you see over here that there is a straight line that you're going, And basically from 0 to 1, the rise over the run which is the tan theta, the base of this, the angle, the slope of this line, the rise over the run, 0.8 to 1, it's 0.8, that is the slope, that is the beta. And that, why we are talking about these lines over here, you will see that when we derive capital asset pricing model, it will be the same thing. So another example, if a company's stock, if your stock consistently goes up or down by 1.8%, when the market portfolio goes up or down by 1.2%, then what will be the beta of the stock? You should be able to make out straight, because you'll do, again, 1.8 divided by 1.2. That will be the beta of the stock, it will be 1.5. Again, this is an aggressive stock. No? So, and again, what portfolio you choose, what stocks you choose, it depends upon the investor's risk averseness. So some people take more chances, some people take less chances, and some people, they combine all these, aggressive and defensive stocks so that the overall beta stays the same as the market. Mutual fund people do that. You'll see many mutual funds that try and mirror the beta of the market. But again, the dispersion is what matters over here, how much, they can change with the market. And that's what you have to see. So beta is calculated with the price data from May 2008 to 2013. All the, from Dow Chemical is 2.34 versus Con Ed 0.17. This is a utility company versus Dow Chemical. You can see the difference between the two. It's a, big change. And by industry, it varies also. So for software, the beta will be different. For pharma, it will be different. Like that. And on an average, but within that industry also, you will have stocks that are different. So you can understand that. See here, if we plot the market's return with, like Dow Chemical, the 2.4 was the beta. Here you can see how steep the line is, the rise over the run. It's very steep. So beta is very high over here. And when you see that for Con Ed, it is very flat. The slope is very less, 0.17 or whatever. So there you go. You can see the difference. And this line over here is the mean. These are the pink, the orange ones are these are the actuals. And then this is a estimate, this is a trend. So the dispersion over here shows that, yeah, here also there are lots of differences. And, the more the dispersion, the more the chances of getting higher returns or lower returns, like that. It happens like that. And the more they're close to the market, the more the chances you'll be just like the market. Most of it will be like the market. So keep that in mind. As I said, mutual funds do like that. They will try and mirror the market. Once again, about portfolios. When you form portfolios out of stocks, different stocks or different firms, remember over here that the beta measures, as I said earlier on, it measures the risk of a stock, and the market risk of the stock is what it measures. It doesn't measure the total risk. The total risk, remember from chapter 11, the unique risk is specific to the business and its comp set, the industry. And the market risk is specific to the market, the macroeconomic effects. So the beta measures the riskiness of the stock, market risk of the stock, not the unique risk. And beta doesn't measure the total risk. Okay? And as I said, the diversification, it decreases the variability from unique risk. It reduces the unique risk, but not the variability from the market risk. Hence, the stock market investors, they tend to ignore the unique risk part more, especially people who go into big diversified portfolios. They will, they focus more on the market. You'll notice.
Professor, I think you went on mute or something. I can't hear you at all.
I'm so sorry. Thanks for letting me know. I'm on mute.
No, wait, Brian, it might be yours. I can hear him.
Yeah, we can hear
Yeah,
you.
I can hear him too.
Can you hear me, Brian? Can you hear me? Maybe you can log back on and then you can, you might, or that will give you a new connection. Thank you. Thank you, folks.
I'll write to him in the chat.
Okay. So can we move on? Brian, can you hear me?
Now I can, yeah, just came back on.
Can you hear me now?
Yes,
Okay, thank you. Okay. So let's start.
thank you.
Yeah, we got to move together. So now, forming portfolios over here, we said that through diversification, we reduce the unique risk, but not the market risk. So when we talk about these mutual fund companies and all these who form big diversified portfolios, they focus more on the market risk because they know that as they keep adding the unique, keep adding stocks to the portfolio, the unique risk part, it keeps dropping off. Until when you take the whole market, which is a full and all the risky asset, then the unique risk is zero there. Okay, just the market risk. So the beta of your portfolio, in this case, whenever you form portfolios, the beta of your portfolio will be an average of the betas of the securities in that portfolio, and weighted average actually. That means the percentage you invest in one stock times the beta of that stock plus the percentage you invest in another stock times the beta of another stock. That will, you add all those things and that becomes the beta of your portfolio. So if you owned all the S&P composite index stocks, then you would have an average beta of the market, 1. That's the whole idea over here. When you form portfolio and you measure the betas of the portfolios. The next slide here, I explain how to form your portfolio beta. So it is what I said just now, it's the fraction of portfolio in stock 1 times beta of stock 1 plus the fraction of portfolio in stock 2 times beta of stock 2. So if I say that, okay, if I have a portfolio beta of a 2-stock portfolio, 60% invested in a company with beta of 1.5 and 40% invested in a company beta of 0.8. So I have an aggressive and a defensive stock. 60% aggressive, 40% defensive. Then the portfolio beta becomes 0.6 times 1.5 plus 0.4 times 0.8 equals 1.22. Okay. So this is how we calculate the beta of your portfolio. It's always good to do that, especially when you're investing in different stocks and they have different betas, So you have to see how much risk you want to take, and the portfolio can help you head in that direction. Now, when we measure the market risk, again, we're continuing. Market risk premium, as I explained earlier before we actually started, was the risk premium of the market portfolio, which is the difference between the market's return and the risk-free rate, which is the T-bill rate, for that period. So we have, the RM minus RF, return of the market portfolio, whichever index you're using, minus the risk-free rate. That is the risk premium. That is the risk premium of your of the market portfolio. So if we have the beta over here on the x-axis and we have the expected return percentage on the y-axis, then for different betas, if we are plotting over here the risk premium of the market portfolio as the difference between market return and the T-bill rate over here. So if you take for each point over here, the difference, if you take the T-bill, normally the intercept over here will be the risk-free rate. The intercept over here will be the risk-free rate. And this becomes the foundation actually. So market portfolio, if we take the difference between that and the RF, which is this, that will give me the market risk premium, the difference. And as we move along, it becomes clearer. So the relationship, it's a straight line, right? It's a straight line. And the straight line equation is what? Mx plus b, y equals mx plus b, the same thing. So we have, if we plot that, that becomes the theory of capital asset pricing model. The theory of capital asset pricing model, talks about the relationship between risk and return, the expected risk premium on any security, which is if you have the R of a security, R is the security's return, then R minus risk-free, which is RF, that is the risk premium on any security, equals its beta times the market risk premium. So risk premium on any security, which is RI minus RF, that equals its beta times the market risk premium, where the market risk premium is RM minus RF. So if you simplify that, you will simply get the expected return, same y equals a plus bx. So here the slope is beta and RM minus RF is the market risk premium. So this is the capital asset pricing model, which simply says that the return, expected return on any stock, on any equity, that it can be measured as the risk-free rate, which is the intercept, plus the beta, which is the covariance of R with RM divided by variance of RM, which is beta, times the market risk premium, which is RM minus RF. This is the capital asset. This here is the capital asset pricing model. And this is what is used by many companies on Wall Street. Of course, there are many variations of this model that have come up now. Brothers, sisters, cousins, but the foundation is this. After this, then there are some changes. Like, the Pharma French model will have 2-factor, 3-factor, 4-factor, 5-factor models like that. When they add, size as another variable that can explain the returns better, or they can take the market to book ratios, the book to market ratios that can explain. So they do like that, keep modifying this. But the basic capital asset pricing model, this is what is used. R equals, or RI, you can say, equals RF plus beta, RM minus RF times beta. So this is a straight line. So again, capital asset pricing models, it is a straight line, provides the market line for a security. It is called the security market line equation. This security R return, security for return R, for an R return on a security or a stock, equals RF risk-free rate plus beta times RM minus RF. And essentially, Sharpe derived this, and this is how he became famous. Says that all the companies, they are related to the macroeconomic market. the market factor. That is the basic thing. And if you, this is the expected return, by the way, ER. This is expected return. And if you open in statistics, when you open the expectation, then you provide an error term at the end, plus ER, you can say, error term. And that error term keeps becoming less and less and less and less as your portfolio gets more and more diversified. That's the whole idea. The unique risk drops off, but the market risk stays. This is also called, beta is also called a systematic risk. Another word for this, systematic risk. Okay. So this is the security market line. The capital asset pricing model. If I plot it, R, okay, R as Y variable, right? And beta as X variable, the risk, R versus the risk. Then there you go. This gives you the security market line. Expected return equals RF plus beta times RM minus RF. And RF is actually the intercept of this line. RF is the risk-free rate, is the intercept, this part. Got it? So here, basically, when you're talking, you know, you can use either, but this is a very, very handy equation. This is for any security, actually. And this becomes the foundation for valuing a security. Measuring a security return. So here, the return example, return on your stock market is 10%. RM is 10%. RF risk-free rate is 3%. What is the risk premium? First of all, what is the risk premium for the stock? That has a beta of 0.5. What is the expected return of that stock? Expected return, we know, the capital asset pricing model we have to apply. So first of all, over here, you have to see what is the market risk premium. The market risk premium is RM minus RF, which is 10% minus 3%, that is 7% is the market risk premium. Just so you know how to compute the market risk premium. And the stock's risk premium is, instead of the market, you use the stock's return minus the RF. RI minus, or the R, which is the return of stock minus the risk-free rate. You know, that is the stock's risk premium. Okay. Now, we want to know what is R, right? So what do? We take expected stock return R as RF plus beta times RM minus RF. So 3% is risk-free rate and beta times RM minus RF. My RM minus RF is 7%, you know, times the beta of the stock. My beta is 0.5. So 0.5 times 0.07 is 0.035. So that is, my beta of my stock is 6.5%. Sorry, the return on my stock is 6.5%, 0.065. Just apply CAPM. And you will see over here, the stock's risk premium will be 0.035. The beta of the stock, you know, times the market risk premium. And you get 0.035. But this is basically your stock's return minus the risk-free. Okay. So this is one example. Here, so when the graph the stock as well as the stock with a beta of 0.2 and the market portfolio. So here you have Y with a beta of 0.2 and here X is the beta of 0.5 and 1 is the beta of the market. Okay, so this is the 0.5 stock that we are talking about. Here is a 0.2 stock. They will all lie over here. The market portfolio, all the expected returns are on this line that we are forecasting, this blue line, the blue line that we are forecasting. This is the expected return line. Got it? And at the beta of 0.1 of 1, the market portfolio lies right here. Okay. And you can see the returns over here. As we plotted for X, we measured return was 6.5%. For Y, it will be 4.4%, you know, at 0.2 beta. If you calculate CAPM, use CAPM. 3% is the risk-free rate. the intercept. 10% is the market portfolio's return. So it's all nicely plotted, you can see. This is how it all works. Once again, the expected returns, you can see it is varying with beta. So for Dow Chemical, which has the highest beta, is 19.4% expected return that period. Con-Ed is just 4.2%. And it makes sense because you get higher returns for taking higher chances and lesser return for taking less chances, less risk. Beta is a measure of risk, systematic risk. So it makes perfect sense. Okay. Now, how do we use the security market line for making investment decisions? It's very simple. If you see here, this is a security market line, and the average return is on the y-axis, along the y-axis. The average return is along the y-axis. One second. Yeah. And the x-axis is beta. Now beta, when the beta is 1, we have the market portfolio. And here are some higher beta stocks, and here are lower beta stocks, some of them. Some of them are more than 1 also. But you will see some examples over here. These stocks, for the same risk class over here, for the same, let's look at these first on the higher side. Okay, higher beta. So here we see these 3 stocks for the same risk class, beta over here at this point. If we go up, the market returns gives us a higher return. So this is inefficient. This will be a negative net present value investment because you can use your money for the same risk. You can get higher returns by spending in the market. So why invest here? This will be a negative net present value investment. It's a high risk relative to the return. The risk is higher, the return is less. Market will give us more return. So any stock that are giving returns less than the security market line, they are a no-no, they are negative, and they are higher than the security market line for the same risk. They are giving more return than the market, then it will always be a positive net present value investment, higher return relative to risk. So the SML also provides a guideline for us, the security market line, for making investment decisions in projects. So if your project's return, this is a project investing in stocks. You can take it as a project. It's a lending project. You're giving out money, right? So you're giving out money over here. It's a project. And if the project's return is higher than the security market line, it will be a positive net present value project. If it is less than security market line, it will be a negative net present value project. So keep that in mind. Okay. They are all related. What you learned in module 3 is related to this in the present value concept. It's all one actually. So then, as I said, there are different models, variations of CAPM. And Fama and French came up with other models, and they said that, look, like the 3-factor model of Fama and French had 2 more variables. One variable was the book to market ratio, and the other variable was the size. And they took the small minus big as one variable, and high minus low book to market. High book to market means a value stock. That means the book is high, market is low, it's a value stock, it will give you more later. So high, provided it has solid balance sheets. So high minus low book to market, you will see over here, they move, they do affect the returns. They have a change, they do affect the returns of the stock. So Fama and French modified the model. It's called the 3-factor model, Fama and French. And then there are more models related to these. So you can keep adding. and we, in our research, when we do research, we keep adding industry-specific indices. We make indices, industry-specific, and we add that to CAPM to make it more precise. So it helps. Once again, capital budgeting, you got a glimpse of it when I said projects that are higher, the returns are higher than security market line or positive NPV project. So project cost of capital depends on the use to which the capital is being put. Therefore, it depends on the risk of the project and not on the risk of the company. So company's cost of capital is the opportunity cost of capital for investment in the firm, and which is the cost of raising capital. Capital is raised how? Debt, equity. So cost of raising debt and cost of raising equity. So here CAPM tells us about the cost of equity, expected return on the equity. So the company's cost of capital is the appropriate discount rate that we use for an average risk investment project undertaken by that company, because it reflects the risk of that company also. So the discount rate that we use, we try to use the company's weighted average cost of capital, which is for all average risk investments made by that firm. So the discount rate in your NPV, in your present value model, will be the cost of capital that will be more realistic. So with that, I think here is another example. Based on capital asset pricing model, ABC company has a cost of capital of 17%. A breakdown of the company's investment project is listed below. When evaluating this is from your book, from this investment, which cost of capital should be used. So from the book, when you say, this is the book example that I've just put here. So 1/3 nuclear parts manufacture, beta is 2. 1/3 computer hard drive manufacture, beta is 1.3. 1/3 dog food production, beta is 0.6. So what should be the average beta of the assets over here? So 1/3 times 2, 1/3 times 1.3, 1/3 0.6 plus the times 0.6, and we add them all. So the average beta of the assets will be 1.3, right? And and then once you have the average beta over there, first of all, when evaluating the new investment, which cost of capital should be used? First of all, we get the beta over here, the portfolio beta that you're getting because of the investment. And it has the cost of capital of 17%. So based on the same thing, same example here, explained further. I just showed you how to get the beta of the portfolio. But based on CAPM, ABC company has a cost of capital of 17%, 4 plus 1.3 times 10, which is, if you look at that example in the book, this is what they have used. And so we use the figures from there. And the breakdown of the company's investment project is listed below. When evaluating a new, which cost of capital should be used. So here we are taking R as 4% is the risk-free rate, plus 0.6 times 14 minus 4. If you're taking, that is what we did over here, 1.3 times capital, cost of capital has, this is from your book. I've taken the numbers from the book. I wish I'd put those, the table over here so we could know where to get the figures from. But basically it says that your 14% is the market premium. This is CAPM. So 14% is the market return, minus 4% is the risk-free rate. So the market premium is 14 minus 4, that is 10%, times the beta, of this. So that becomes 4, you take the expected return, of that company. So it becomes, this is the expected return, 10% is the expected return, which is all equity if you're taking over here. So this is for all equity, 10%. So 10% reflects the opportunity cost of capital of the investment given the unique risk of the product. Unique risk just based on that company or that product. So that's what they're doing over here. But if you look at the textbook, and I actually have the textbook open over here. So if we go to chapter 12, I can give you the exact numbers for this. Chapter 12. Give me a second. I apologize for the inconvenience over here. But let's go down. What happened here? Okay. This is chapter 12. Okay. And risk and diversification, cost of capital. And then this goes down in this auto stock rate of return. One second, I'm just trying to get the exact numbers from the book. So this is chapter 12. So but the whole idea is it's an application of capital asset pricing model. And another example for applying the capital asset pricing model. That's what it was. So there we go, opportunity, cost of capital. And yeah. So here, this is what it says, right? So this is, the example says, cost of capital, project's risk. This is says that project cost of capital is the minimum acceptable expected rate of return given the risk. Okay, so it says here that if the project offers is 3%, now these numbers are different. 6.7. Cost of capital. Anyway, I can make another example for you and give you another example. But in the first example over here, I've shown you how to get I think maybe I'm missing one slide here. That's why it is the numbers are not there. So in the first example here, we have when you're spending in your portfolio, 1/3 of your investment you're spending in nuclear parts manufacturer with a beta of 2, 1/3 in a computer hard drive manufacturer, beta 1.3, 1/3 in a dog food production, beta of 0.6. So my total average beta is 1.3 for this. And now over here, breakdown of the company's investment I showed in the previous slide. So when evaluating the dog production investment, which is the previous one, beta of 0.6. So when evaluating a new dog food production investment with a beta of 0.6, which cost of capital should be used? Obviously, you'll use a beta of 0.6 over here. You'll use the risk-free rate of 4%. The market's rate of return is 14%, which number I was missing over here, but that's the market's rate of return, 14%. So the cost of capital I will use for this project because it will be pertinent to the risk of the dog food production investment. So my beta is 0.6 for the dog food production. And I will use that beta then because the riskiness will be parallel, right? The same, right? So I will use the beta of the dog food production 0.6 plus times the market premium, which is 14 minus 4, which is 10%, plus 4%, which is the market's risk-free rate, and that gives you 10%. So this is the cost of capital that I will use, to evaluate the unique, given the unique risk of this dog food production investment. So basically, this is what it shows. That use the cost of capital in the same risk class. So that was another example. But we are going to go further into the weighted average cost of capital and going to go into more specifics here. How to value a company. So here we'll talk about the capital structure, cost of capital. Capital structure is, again, as you will notice, we are building into new topics. So from here, we realize that the debt and equity mix is very important. So the cost of capital and capital structure are related. So we'll talk about them. We'll talk about how to calculate the weighted average cost of capital, WACC. So here, first of all, the cost of capital, when we are talking of cost of capital, we know by now that what is it? It is the return that the investors could expect to earn if they invested the company's existing securities with comparable degrees of insecurity with comparable degrees of risk. So if you're investing instead of your company, you're taking it and investing it somewhere else in similar risk, what return would you get? So that is the cost of capital, and that is related to the capital structure of the company. And we will see how it is related to the capital structure. Capital structure simply means the mix of debt and equity, mix of long-term debt and equity financing. How much debt, how much equity to raise your finances. Okay, that is what we mean by capital structure. And your capital structure decisions are very important because they affect your cost of capital. They refer to the decision of choosing the blend of equity and debt to finance your firm, your firm's capital. And how we measure the cost of weighted cost of capital is we take a weighted average of the cost of debt and cost of equity. We had this question earlier on in module 3, where we talked about, what should be the cost of capital. And here is the answer for it. The cost of capital that we should use is the weighted average cost of capital of that company. And the weighted average cost of capital is the expected rate of return, that you would get for financing your capital both by debt and equity and adjusting it for the tax savings due to the interest payments. Because your debt is, your debt service payments are tax, they have tax implications. The interest payment has tax implications. So we adjust that and we'll see how here. So, as I said, taxes are important consideration because the cost of debt because interest payments on the debt are deducted from income before tax. They're deducted from income before tax. So my after-tax cost of debt is what? My pre-tax cost, which is the interest rate, times 1 minus the tax rate. Our debt times 1 minus the tax rate. So you adjust the cost of my adjusted cost of debt, after tax cost of debt, is the interest that I pay on the debt times 1 minus tax rate. So that is the adjusted cost of debt. And the cost of equity, we already know from CAPM, capital asset pricing model, or equity. So now we are in a position to compute the weighted average cost of capital of your company, which we use as the discount rate. So the ratio of debt to value. So how much of my total assets is financed by debt and how much of it is financed by equity. So debt to value times 1 minus tax rate, weight times after tax cost of debt, or debt times 1 minus tax rate. Weight of debt plus weight of equity times cost of equity. Now, when we talk of weight is what? The value is debt plus equity. Now, the traditional way is to use the book value. People have been using book value on the balance sheets and they just do it like that. But the practical way is to use the market value. That way you will get a more realistic estimate of your weighted average cost of capital. And the market value of equity is very, very easy because you have the number of stocks outstanding times the stock price. So that is the market value of the equity. But the market value of the debt is you take the market value, present value of the bonds, and that will give you the market value of the debt. But the market value of debt does not make so much difference. The main difference comes when you use the market value is because of market value of equity. It's a big difference. So again, weighted average cost of capital is the weight of debt, debt to value times after tax cost of debt, which is the interest rate times 1 minus tax rate, plus the equity weight, which is E by value, times the cost of equity. So 3 steps. First is calculate the market value of each security as a proportion of the firm's market value, that is its weight. The second step is to determine the required rate of return on each security. Use CAPM, capital asset pricing model. Third is to calculate the weighted average after tax return on the debt. So, and the return on the equity. So weighted average after tax cost is what? Or the weight of the debt times interest rate times 1 minus tax rate. And then you get then you add both and you get the weighted average cost of capital. So now sometimes you don't just have common stocks, you have preferred stocks also. So in that case, you will have you add the weight of the preferred stocks times the return on the preferred stocks. Okay. Whereas return on the preferred stock is very simple to calculate. It is the perpetuity formula that we use. So the dividend paid by the preferred stock divided by the price of the preferred stock. And, so you add that, R preferred times weight of the preferred, or equity, common equity times weight of the common equity, and the after-tax cost of debt times the weight of the debt. We add all these 3 and then we will get. And I said we'll get the weighted average cost of capital. I said that the cost of preferred stock is its dividend yield. The cost of preferred stock is the dividend of the preferred stock divided by the price of the preferred stock. So if there is a preferred stock with dividend yield of 12%, right? Preferred stock with a dividend yield of 12%. Dividend yield, this term means dividend divided by the price. This is the same thing, dividend yield. So if it has a preferred stock has a dividend yield of 12%, that means it will have a cost of 12%. Right? This is the cost of 12%. Another example, executive fruit. This is also from your book. You can go through this as we go along. But here the data is that the market value of these securities in the capital structure of executive fruit are 4 million debt, 2 million preferred stock, 6 million common stock. And the required returns are 6% 12% and 18% respectively, determine the weighted average cost of capital for this fruit, executive fruiting. So you take the weight, first of all, the total market value is to add the market value of debt, preferred stock, and common stock is 12 million. And then you calculate the weighted average cost of capital using the weighted average cost of capital formula for this. And basically, the required returns are already given, 6% over here, 12% and 18%, 6% debt are then 12% preferred and 18% equity, right? So then you calculate the weighted average cost of capital, taking the weight of debt 4 divided by 12 times, and tax rate they've assumed 35% times 6% interest rate on the debt. This is the weighted cost of debt. And then you take the preferred stock, 2 million divided by 12. That is the weight of preferred times 12% is the return on preferred stock, which is the dividend yield of preferred stock. And then 6 million is on common stock. So 6 out of 12, half weight on common stock, and 18% is the return cost. If you add all these three, you get 12.3% as the weighted average cost of capital. So you can use the same straight, keep adding the weighted cost of each security, and you'll get the weighted average cost of capital. So when you estimate the weighted average cost of capital, as I said, use the market, not the book value of the securities, wherever you can. The weighted average cost of capital can be used to determine the value of a firm by discounting the firm's free cash flows. Okay, and we'll talk about this more. You take the free cash flows, final free cash flows of the firm, and discount it, expected cash flow from the firm, and discount it by the weighted average cost of capital. And you will get the present value. The weighted average cost of capital is the minimum after-tax return a firm must earn to satisfy its security holders. That's the bare minimum. Preferably, you should beat the cost of capital. But that is a bare minimum to break even, minimum required. Okay. The investment project with same risk and financing as the firm will have a positive net present value if its rate of return exceeds the firm's weighted average cost of capital. Once again, if any investment that you're making, make sure that the return that you get from it, expected return, is more than the cost. Principle of value-based planning. That's what it is. Now, as I said earlier also, it's the weighted average cost of capital, the benchmark discount rate that is adjusted for the riskiness of each investment project. For different risk projects, we use different. And we saw that for that, the food company that we were saying, we just took the beta, the riskiness of that company. So you have to adjust it for the riskiness of each investment project. And as I said, in the same risk, with the same risk, if I have an investment project, the same risk and financing as the firm, it will have a positive net present value if its rate of return exceeds the weighted average cost of capital. So here in your book, they have done a comprehensive example, measuring the weighted average cost of capital for big oil. They have given, the breakdown, bank debt, 9% yield to maturity, 200 million. Then long-term bonds, 12-year maturity, 8% coupon, 9% yield to maturity is again 200 million. So your bonds and your debt is 50% is debt. And then and both have 9%. For simplicity, they have kept 9% yield to maturity. And common stock is 100 million, $1 par, $12 market value. So $1 par 100 million is book value is 100 million. And then retained earnings is 300 million that you've retained back from the profits for this firm. Also part of your equity, that's 37.5%. So your equity is 50% and your debt is 50%. That is a mix over here. So first, when you calculate, you'll have to calculate the market value of bonds for the debt, present value of all the, of all 8% coupon for this, par value discounted at yield to maturity 9%. So you get the market value of the bond, you calculate 185.7 million for the big oil company. And the market value of equity, which is $12 per share, 100 million shares outstanding. So it's 1,200 million is the market value of equity. So if you take that and at 8% coupon, the long-term bonds, 8% coupon, 12-year maturity, then for the present value of the bonds over here, 200 is the face value. The 216 is 8% of 200 is 16. This is the coupon you keep getting every year, right? You have to keep paying every year for the bond. Plus at the end, it is the face value plus the coupon, 200 plus the coupon. So you do all that and discount it at the yield to maturity of 9%, take the present value of that is 185.7. That is the present value of your bonds over here. So if you take all these, use the market value, and instead of the book value, if you take the market value, you will see that see in red over here, the common stock, it makes a big difference. Instead of $100, it becomes 1,200 million. 100 million becomes 1,200 million. So 75% equity over a common equity, and 75% equity, 24.3% debt versus 50-50. So your capital structure changes if you take the market value, and much of the difference is because of the equity. So keep that in mind. So for common stock, for big oil, 0.85 beta, 12% is the RE, and 9% is the return for bond. If you add all those things, then you can compute the weighted average cost of capital by just plugging in those numbers, and it is 10.5%, you can see from this. So it's very simple to calculate the weighted average cost of capital now that and use the weighted average cost of capital for discounting purposes. For the required rates of return, RE, can also be calculated using the dividend discount model that we learned earlier on. The cash flow dividend divided by RE minus the growth rate. So you can get the required return RE as, if you readjust these numbers, what is a dividend discount model? Dividend discount model simply says that the price of the stock equals the discounted value of the dividends, cash flow that you keep getting every year from it, divided by, RE, the return, the required rate of return on the stock R. Of course, if there is a growing, there's a growth, then you deduct the growth rate, the constant growth rate from it. Otherwise, this is a perpetuity formula. Dividend divided by RE, this is the perpetuity formula, common present value of perpetuity. So we do that minus G. If we adjust these numbers, we rearrange, then RE you will get as dividend over P's over the price, which is the dividend yield plus the growth. So you can also get the RE from the dividend discount model if you don't have those, the risk-free rate and all those things. That's another way of calculating it. Dividend discount model, cost of equity. Perpetuity growth model. This is what it is we use when we solve for RE using the dividend discount model. So here is an example. We apply a dividend discount model. Shareholders require 18% return on equity, RE. Dividend yield, dividend to price ratio is 10%. Expected growth rate, G, is the expected growth rate in dividends, G, equals the equity return minus the dividend yield. So that is 8%. So what is the expected growth rate? This is what we are doing over here. So if the shareholders require 18% return on equity. RE is 18%, right? And dividend yield, dividend over price, or the dividend price ratio is 10%. This is 10%. This is 18%. This is 10%. The RE is 18%. Dividend yield is 10%. What is the growth rate? Growth rate will be RE minus dividend yield, which is 18 minus 10, 8% will be the growth rate. So you can easily find out these things. Dividend discount model. Here's another example, right? Stock sells for $40. This is the price of the stock, $40. Pays 4.25 as a dividend, right? Dividend is 4.25. Growth rate is 5%. What is the cost of equity? Very simple. We can take the dividend yield for 4.25 divided by 40 and plus the 5% growth rate. So that is 15.63% will be the cost of equity for this using the dividend discount model. So how to interpret the weighted average cost of capital? Very simple. Weighted average cost of capital is an appropriate discount rate only for a project in the same risk class. Carbon copy of the firm's existing business, same risk class. There are two costs of debt financing we all know by now. One is the explicit cost and the other is the implicit cost. What is the implicit cost and what is the implicit cost? Is the cost required, the required increase in return from equity. If you take more debt, then what happens? Higher the debt, the more risky. Number one is the explicit cost. If you take more debt, then the lenders will be more skeptic and they might raise the interest rate. They'll say, oh, you are becoming more and more risky, so I'll give you higher interest rate now. So that is the explicit cost. The bondholders that demand more for higher level debts, returns for higher level debts. And the implicit cost is if you take more debt, then your equity also tends to get more risky. And if your equity tends to get more risky, then the shareholders will say, we want more return because you are more risky now. Okay. So both costs are there in debt financing. So you can't just say that, hey, my debt to equity ratio is very low. I just borrow more money. That will because debt tends to lower the overall weighted average cost of capital. But what happens really is if you borrow more money, yes, to a certain extent, you will, actually there is a curve. You will learn that in chapter 16, there is a curve. Up to a certain extent, it will work. After some time, it will start declining. That means it becomes adverse. You can't borrow more and more and more. So what happens is basically, if you're paying more for the equity holders, they start demanding more, then your reduction in weighted average cost of capital doesn't work that way, the way you want. It depends how much optimum for your business is, what is the optimum level of debt. And this question has been from the beginning, age-old question, what is the optimum level of debt for my company? You know, and it keeps changing. You have to keep monitoring it properly. It's not a straight line. It is a U, inverted U, and you will see how it works when you do chapter 16. So it's not a simple answer that yes, I keep borrowing more money and I'll keep lowering my weighted average cost of capital because your equity tends to get risky too. That is the implicit cost. Okay. Some issues in using weighted average cost of capital. Remember that it has two costs, return on debt and the increased cost of equity demanded due to increase in risk. Also remember, betas may change with the capital structure. Of course, it will change with the capital structure because the riskiness changes, right? So betas may change with the capital structure. And but it's very easy to compute betas. Betas of the total asset will be, again, a weighted average of the beta of debt and beta of equity. So again, you take the debt to value times the beta of debt plus equity to value times the beta of equity, and there you go. You can get the beta of your assets. remember that when you apply all this for valuing companies, you want to create determine the value of it. What is the value of my company? Then in that case, use the free cash flow, FCF. They should be the basis for all present value calculations in valuing companies. And the free cash flows is more accurate measurement of present value than the dividends or the earnings per share. Okay? And also remember that the market price does not always reflect the present value of the free cash flows, because market price also depends upon a lot of information asymmetry issues and other variations. So keep that in mind. When valuing a business for purchase, always use the free cash flows. And what I'll do is I'll show you with an example now. When you value the business, what do? You calculate the present value of the free cash flows from now till the end, till a valuation horizon. Valuation horizon is sometimes called the terminal value. That means, say you run a business for some time, and at the end, let's say you sell it off, or you don't want to sell it off. See, in the beginning, you will have a negative cash flow for some time until you become stabilized. And once you're stable after a few years, then you can assume that you will get a constant rate for some time. So that is called the valuation horizon. So that is at the end, you take the present value of the valuation horizon cash flows, discounted by the weighted average cost of capital. Let me show you with an example over here. So basically what I'm saying is, take the present value of the free cash flows of your business for some time until your horizon is reached, until your stability period is reached. So discounted by the weighted average cost of capital through and through. And then at the end, add the present value of the horizon value. So, and I'll show you over here as an example. So if you can see my slide, I just put the forecast from table 13.5 in your book is operating cash flow and investment for a company, the Concatenator Manufacturing Division, in thousands of dollars. And notice over here is the rapid expansion. It means that free cash flows is negative in the early years. So here at the bottom is row 10 is the free cash flow. You see negative in the early years until year 4 it is negative. Because the investment outstrips the cash flow from the operations, and the free cash flow turns positive when growth slows down. So high growth period, obviously you will be, there'll be negative free cash flows. So how to get the free cash flow? So you have your sales minus your costs, that is your EBITDA, right? Sales minus your cost is your EBITDA. And then you have your depreciation. So your profit before taxes is your EBITDA minus your depreciation. DA is for depreciation. So minus your depreciation. That is your before tax profit. Less, if you're assuming 35% tax rate, so less the income tax at the pre-tax on the pre-tax profit. So your after-tax profit you're getting, this is the accounting profit that you're getting, in row 7. And then in row 8 is the operating cash flow. The operating cash flow is essentially this is simple accounting that people use, which is your depreciation, row 7, plus your net profit after taxes. So depreciation plus after-tax profit is your operating cash flow. And to get the free cash flow, what you do is from here you deduct your investment in fixed assets and net working capital. Then what is remaining is your free cash flow. Your fixed asset you have to you're investing in, and your net working capital you're investing in. So after you deduct all that from your operating cash flow, that is your free cash flow in row 10. Okay. So notice that in the first 4 years, the free cash flow is negative. And then after that, you're assuming that your horizon period begins after year 5. It becomes more stable. So you take the earnings, the cash flow for year 6, then the free cash flow for year 6, as your horizon cash flow. Got it? So now you are ready to value this company by discounting it at the weighted average cost of capital of this company. So here, first of all, the horizon value. So what we took year 5 as the horizon year because the business is expected to settle down to steady growth, and the growth is expected at 5% a year from after 5 years. So the horizon value using the constant growth formula will be your free cash flow in year 6 divided by R minus G. So here the horizon value for your company is, 303.8 divided by the weighted average. This is R minus G, 0.085 minus 0.05. Growth is 5% over here. So the weighted average cost of capital is for this company is 8.5%. That's basically, how do you get that? You get it from your debt and equity mix. And if you read this example in chapter 13, they will give you that, that it is 8.5%, the weighted average cost of capital. And we use the formula, the discount formula, free cash flow divided by 1 plus weighted average cost of capital, which is 8.5% for this company. And it is given in that example, and that's what I have used here. So 8.5% minus the 5% growth rate. The horizon value is 8,680, and my free cash flows over here, for the years 1, 2, 3, 4, and 5 are from row 10 we took, and the last year horizon value I took based on the discounted constant growth formula. We use that. It is 8,680,000, 8.6 million is what it is. And so total, you're getting your present value of the free cash flows is 5,697.50. And that is how this is the value of the company. This is the